I've been asked today to talk about global economic conditions, and as Jackie said, there's really a lot to talk about. And as I think about the story that we've had over the past couple of years through the pandemic, it's kind of like a story with twists and turns, but I think I might just sort of describe 2022 as a complete plot twist. So if we look back where we were a year ago, because I think it is helpful to think about where we were a year ago, and maybe we're sort of more in that short time frame on this presentation. And where we were a year ago, well, in Sydney we're in lockdown, but if we're looking around what was happening around the globe, we were looking, I guess it was a bit of a turning point in the story. Vaccines had been being rolled out, and we were looking at a global economy that, I guess, cautious optimism about the recovery that was happening in the global economy. It wasn't necessarily going to be smooth sailing at that point, but things looked like they were on a path on the way up. We had a little bit of inflation at a few places like the US, but it was more around country-specific factors, so it wasn't a broad-based problem. Now, when we get to, I guess, the end of the year, we have Omicron. It's causing a little bit of disruption, but firstly, Omicron wasn't as severe as the previous pandemic waves, and also it was less disruptive. Over time, we found the different waves of the virus to become less disruptive over time. And I think at that point, we were all sort of hoping that we were going to be basically writing this last chapter of the story. And then we come into the first few months of 2022. And the big wild factor, of course, was the Russian invasion of Ukraine. And in the back of that, we saw the emergence of this high inflation environment. So that's what I'm going to focus on today, is sort of the range of supply factors that led to the supply shocks, the high inflation environment, and how these things are combining to cause risks to our global outlook and causing complications for monetary policy. And of course, we're not immune from that from a domestic perspective as well. So let's start off with the general facts here. And inflation now is sitting at a very high level, really. Headline inflation is that sort of 6 to 9% of most economies around the world. And you can see that this is really a global phenomenon in most cases. There's a few exceptions there, like China and Japan, but inflation is really high in most locations. And this really contrasts to our experience over the years prior to the pandemic. And in fact, inflation's now its highest level since the 1980s, and I'm sure that's what Tom was just talking to you about. And it's quite a shift from the low inflation environment that we've come from. So I think there's a few things to pick up on this graph. One is the really rapid pickup in inflation over the past year. And this is coming in this context of the sequence of shocks. And so the shocks that I think we need to keep in mind here, I think there's three really to highlight. One is the general disruptions to supply chains through the pandemic period. The second is around the rather large disruptions from the Russian invasion of Ukraine that's caused a lot of disruption in energy markets. And then the third thing is whether we're going to see the risks around the supply chain at this point in the story. So are we going to see further shocks? And particularly, I think we need to keep an eye on what's happening in China on this one. And we'll loop back to that in a bit. Now, the context here also really matters. It's not just about the supply shocks. These supply shocks came on top of a time in which the global economy was recovering very strongly. There's lots of supply constraints, and labour markets were tight as well. So it's that combination of supply shocks hitting the economy with little spare capacity that's led to a lot more inflation than we might have otherwise expected. Now, most central banks around the world are expecting inflation to fall from here. So the nature of supply shocks is that we tend to think that they will be temporary. So we would expect those sort of supply chain disruptions we saw through the pandemic to start to ease and resolve over time. And even if commodity prices remain at their current high levels, they won't have ongoing effects on inflation. So you'd expect high levels of inflation to come down. I guess the challenge that the world is facing at this point is particularly around that core inflation number. Are we going to see some real persistence on that core inflation, particularly if we're seeing a big pickup around wage claims in the period ahead? Now, one of the questions I think people are asking, as central bankers are asking themselves, is whether there's a real shift here. Up until now, we've been through this low inflation environment. Basically, inflation's been low enough that it's been able to be ignored to some extent by economic agents. But do you move to a new place when inflation is sitting up there at 6, 7, 8, 9%? Does that change the nature of price setting in the economy? Does it change the nature of wage demands that are coming through? And certainly if you were talking to people in Europe, you'd get the impression that it is going to be changing some of those wage demands. And we're thinking a lot here about how higher inflation could be shifting the psychology around price setting here in Australia as well. So I want to talk through some of these significant supply shocks that have been coming through. I'm going to talk through this in a bit more detail, and then sort of some of the implications for the global economy. So let's start with the effect that the Russian invasion of Ukraine had on commodity markets. Now, the left-hand side of the graph is really the big part of the story that's causing a lot of concern. So, and I should mention all this, when we're talking about pandemics and wars in Ukraine, I'm very much focused here on the economic story, but I don't really want us to lose sight that this is, first and foremost, these things are humanitarian events. So we need to keep that in mind. The Russian invasion of Ukraine had really significant effects on these commodities. Russia is basically a major exporter of all these commodities. They're the world's largest export of natural gas, most of that going to Europe. They're the second largest exporter of crude oil, and they're a major exporter of thermal coal. On the right-hand side of the graph, Ukraine and Russia together account for 30% of the world's wheat exports, and they also export a range of other commodities, and I've got vegetable oil included on this graph. And so when Russia invaded Ukraine back in February, this came on top of a period in which energy markets were actually already pretty tight. That was on the back of the demand picking up through 2021. And so when this happened, basically we saw some pickup in prices in these economies. Now that wasn't because necessarily supply shifted away at that very moment. The supply of gas has continued to flow to from Russia to Europe through this time, although there's been some disruptions. But there's increasing concerns about whether there'll be more disruptions in the period ahead, and that's been quite a focus in recent weeks. There's also the intent by Europe to shift away from their dependence on Russian oil and gas, and so that's been something that's been underpinning prices. Now, there's lots to be said on commodity markets, lots of very idiosyncratic factors, but let me just make a few points on the energy side. One is that it's expected that these prices will remain high for some time because of these underlying developments, and that the disruption coming from Russia will persist. And because there's going to be this transition that they try and move away from their dependence on Russian energy. The second thing is that there's spillover between these markets. As gas prices rise, they're spilling over there into coal, because both of these things are inputs into electricity production. And the third thing to mention here is that there's really been an underinvestment in these markets for some time, and that's one of the reasons why it's so tight. There's been some underinvestment because of uncertainty around climate change policy, and also there was some underinvestment during the period of the COVID period. And so we've got a range of things going on here. So one of the reasons why I've shown here the price of refined oil products, it's actually the refinery margins that are going up here quite strongly because there's not enough capacity on refining. We've had thermal coal because there's not been as a lot of investment in coal-fired power plants as countries have tried to move away from that. But at the same time, there's been lack of investment in nuclear power in Europe and so forth. So there's a range of things going on here underpinning these higher prices. You can see on the other side, I won't dwell on that wheat prices went up a lot as a result of the war. They have come down a bit. Harvest is good in some areas of the world, but wheat prices do remain quite a bit higher than they were a year ago. Now, one of the things that happens when you have this really large increase in commodity prices is that it is a benefit to countries that export these commodities. And so I'm going to flick over to this chart, which is this is Australia's terms of trade. So one thing that happens is that commodity prices increase and we get a bit of an income boost here in Australia because this is an income boost to the owners of those of mining firms. Now some of that money is going to leach off to foreign investors, but some of that money is going to stay here in Australia, and some of that money is going to end up in the hands of government revenues. So there is a positive income side to this story. We don't think this is going to result in the same sort of investment we saw during the mining investment boom back in sort of 2009, 10, 11, 12, but and that's what we're hearing through our liaison program. But there is this income side. But overall, we would think about this shock as being contractionary. It is something, so energy prices in particular is an input into the cost for most firms in the economy. It's an input into the cost of production and into distribution channels. So it would tend to be a constraining factor on firms. For households, of course, both sides of this picture, energy and food, are things that are pretty essential in people's consumption baskets. They're not the things that we tend to give up just because prices rise. And so that's impacting on our purchasing power for other items. I just popped this graph in as a reminder that there's a lot going on, and concerns about the global economy is actually starting to see commodity prices in a number of markets start moving in the other direction, but energy prices are really staying quite high. Another supply shock that I said I would talk about is particularly these sort of disruption to supply chains that we saw throughout the pandemic period. Now, the supply disruptions that we're talking about here is that cities went into lockdowns, production was cut, and this caused delivery of items to be delayed and difficulty getting goods from around the world. Now, if you have one component that's now in short supply, this is going to cause disruption to other firms that are relying on that component. So you have these sorts of additional spillover effects. At the same time, and this sort of happens, I guess, particularly in a world in which you have this sort of just-in-time inventory management. You don't get hold of this supply, and then things get held up along the way. At the same time, we've got this shift in strong demand towards goods, further exacerbating these problems, and bottlenecks arriving in the sort of the shipping that's happening around the world. So there's lots of stories about ships being caught off outside ports and unable to be cleared. And so in this context, we saw some significant disruptions, and I don't need to tell you, anyone who's tried to buy something during the pandemic knew the fate of having to wait for that thing to be delivered and hoped it would, I guess, arrive in time, whatever that in time meant. Here is a suite of indicators that we've been looking at. And I think the thing to really note here is that we can see actually some signs that these supply constraints are actually starting to ease. So if you look at the bottom right, the bottom left panel, delivery times there for most of the world have started to show some sign of improvement. Shipping costs have been boosted, of course, because of high energy prices, but that seems to have stopped rising. Semiconductors are called out here because they are one of those sorts of inputs into production that really matter for a whole lots of other items. And inventory to sales are starting to improve. Those started there for the US, as long as it's not for a car. And so I think we are starting to see this improvement, but there are some risks around supply chains. And one particular risk that we're keeping an eye on is what's happening in China. And so that bottom left-hand panel, the red line for China, you can see two big spikes there. And they really point to the two significant lockdowns that they've had through the pandemic period. So the first one being the lockdown in Wuhan, and the most recent one being the lockdowns that we saw in Shanghai and Jilin, and some less severe measures that have been taken elsewhere, including in Beijing. Now, the thing to note here is that when lockdowns happen in China, they tend to be severe but relatively short, and you can see that things are starting to come back and delivery times are starting to improve in China already. But China remains an important country to watch in the year ahead. China is the second largest economy in the world, and obviously our major trading partner, so it's a pretty important thing to watch. A couple of points to make from this graph. Firstly, in terms of the disruptions that we've seen in China, if you look at the top line there on exports, The disruptions to exports, even with the significant lockdowns that we've seen recently, have been pretty short-lived in terms of their exports. And so those sort of supply chain concerns that have been people been worried about haven't really amounted too much, and that's sort of consistent with other indicators that we're looking at. But the other thing to take from this is that the lockdowns that they've had in China even recently, they've only locked down a relatively small proportion of their economy. I mean, Shanghai and Jilin and Beijing are pretty large, but still that's sort of in that 10% range of the economy. But they really had big effects because those lockdowns were so severe. So the lockdowns are severe, they're having big effects, but they tend to come back relatively quickly in China. So the optimistic view is that they can come back and recover quickly. The bigger concern is that no country in the world has really managed to get Omicron under control, and the Chinese authorities are prioritising this sort of dynamic zero policy. They're really trying, dynamic zero means it doesn't have to be zero exactly, but really trying to contain COVID in the period ahead, and that seems to be their priority, and that's the biggest risk for the Chinese economy from our point of view in the period ahead. The second risk to the Chinese economy is vulnerabilities in the housing markets, which is why we've caught up the housing sales data there. They've had quite a few weaknesses on their property market, highly leveraged sectors, and so that remains an area of concern as well. Overall, people are expecting the Chinese economy to grow. The Chinese authorities are very focused on providing a lot of stimulus, but dependent on what happens to COVID. So I've covered off, I guess, a number of the supply shocks that have been affecting the economy, the supply constraints from, I guess, in terms of goods distribution. The other constraint has been in the labour market. So what this graph is, it's a graph that compares the current unemployment rate around the world with its low point over the last three decades. And so basically what this graph tells you is that, with the exception of Sweden on this picture, the unemployment rate around the world is pretty much at its lowest point in the previous 3 decades. And in fact, for half these countries, it is the lowest point in the previous 3 decades, meaning that labour markets are exceedingly tight, and exceedingly tight all at the same time. Now, I think this partly speaks to the amount of stimulus that went into the global economy through the pandemic, that we sort of ended up with such significantly low unemployment rates. This is quite a positive, I think, from the household perspective. If you want to think about what leads to good outcomes for households, you give them a job, you give them income, but it also means that there's not much give in these economies, and this is the environments when we would expect to see wage pressures emerge, and I guess that is what we are seeing at the moment. In terms of other things that sort of point to some of the strong position, that starting position here for households is in this right-hand graph as well, which shows the household saving rate. Now, I don't know if we were seeing the household saving rate earlier today for Australia, but I mean, this has sort of been a picture around the world that households saved a lot of money during the pandemic. So this is a pretty unusual economic downturn, that you end up at the end of the time with unemployment rates at pretty much historical lows, and household balance sheets in a stronger position than when we started. And you can see from this in the comparison that Australia is actually at sort of a bit of a stronger position than we're seeing in many other countries, with a bit further to run in terms of being able to reduce their savings in order to cushion the effects that we're seeing around higher prices. So the Australian consumer is perhaps in a slightly stronger position than we're seeing in some other locations. The left-hand graph tells you what we're worried about. And what we're worried about from the global perspective is that inflation is really eroding real incomes. And there's some very large falls there in real incomes being seen across the globe, and including in countries where wages have already been rising quite strongly. And so this is an environment which, I guess, there are some sort of, there has been this strong underlying demand, but we can see the signs of things tipping. And we can see the signs of things tipping with inflation being high, and then higher interest rates is also reducing the disposable income available to consumers in many economies. And so perhaps we don't find it surprising that this is having an effect on consumer sentiment. And this is, I guess, a key risk around what we think might be happening to consumption. Now, of course, remember, consumption is always an important driver of growth. Here in Australia, it's about 60% of GDP. I'd expect it to be about the same around the world. So what happens to the consumer matters. And this is on top of, I guess, what, in a world in which we're raising interest rates, world's raising interest rates, then the interest rate sensitive sectors of the economy are going to be susceptible to turning down as well. And so it's in that setting that we've seen a lot of discussion around the world about, I guess, risks to global growth. And so over the last few months, we've seen this sort of downward revision around the growth outlook. And if you read the papers, you would have seen a lot of discussion about this type of, increasing concerns about what's happening with the outlook for global growth. And I think that's a lot of that, as I said, is sort of linked to this concern about how high inflation and high energy prices will lead to a pullback on activity, and that can be exacerbated by the central bank's efforts to rein in inflation in this environment. So in terms of the inflation outlook, I wanted to loop back to inflation expectations before we just talk about where things are up to in terms of policy settings around the world. We don't actually have really great measures of inflation expectations. This one is taken from markets. And so this tells you that markets are expecting inflation expectations to come back down in the period ahead. Some consumer-based surveys would have it sort of rising a little bit, but generally, as things stand, it suggests that there is this belief that there's not going to be the sustained level of inflation. But I think that time will tell, and it depends, as we spoke about earlier, what happens in terms of wage setting more generally. So what has this meant for monetary policy? And I think that there's been central banks have really are facing quite a difficult, sort of challenging set of conditions that they need to respond to. Let me explain what these graphs are showing you first. So the graph on the left shows what's happening with policy rates in the solid line, and then the dashed line, coloured lines are telling you what markets' expectations are for interest rates in the various countries. This graph was done on Monday, so it doesn't include the latest move here for the Reserve Bank. But there's a couple of things to note from here. One is that basically interest rates are moving up around the world and actually moving up fairly aggressively, and they're expected to move up higher still in the period ahead. Now, I think one way to think about what's happening here is that basically we're starting from this position where interest rates are at this emergency setting set for the conditions of this, 1 in 100-year event of the pandemic. I personally find the sort of analogy that's helpful is to say that, what's happening in this environment is the sort of the foot's being lifted off the accelerator rather than being put on the brake. So with this sort of normalisation of rates back towards something that's going to be a bit more neutral for the economy. When you're coming off a low point and you know that you need to get higher, and particularly in a world in which we sort of have inflation expectations expected to be around 2% or so, there is this potential for countries to move relatively aggressively because there's space to get back to that neutral rate. I think there are challenges around this. I think that these moves are being done with a clear eye to the inflation risks. So as I showed you in the last graph, there are good stories to tell that we might not see inflation become embedded, that there are these sort of driven by supply shocks and inflation could come back down. But bringing inflation back down is costly. And so there is this sort of incentives for the central banks to be a bit ahead of the curve on this. The right-hand graph just shows what's happening with central bank bond purchases. Just a reminder here that this is part of what central banks have been doing over the past few years. And so basically as we stand here at the moment, I should mention on the left-hand side, basically everyone's tightened here except for the euro area, and they have clearly flagged that they intend to raise rates at their July meeting. And on the right-hand side, basically central banks around the world have finished their bond purchase programs, just with the exception of Japan.